Hello, everybody. I'm your host, Eric Bird, here at StopStrugglingNow.com. And today we have to talk about that stock market, ladies and gentlemen. You have to understand the stock market is going down like it's 1929 to 1932. I'm going to give you the numbers, and of course, we're going to talk about what you can do about it. But first, welcome. Stop Struggling Now gear. Check. And please like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it. All right, ladies and gentlemen, once again, please share the videos. And you never know who you're going to help. But let's talk about this. Get your free stocks from Robinhood and Webull. That's right. And then use your link and share your link with other people that can get these free stocks. You know why? The stock market is down, ladies and gentlemen. And before we get into that, we're going to have to go to the screen here, right? Because you guys know, make sure you smash that like button. And what I'm talking about is also the subscribe button once again and the join button over here on the right hand side. This is how you become a member of the channel, like these members that are shown. And you receive special messages under the community tab. You also receive a couple of videos per month. You have special emojis. You can also be the only ones in the chat room on our Wednesday night live streams and a few other perks. Now, without further ado, share the videos, smash the like button, get your free stocks from Robinhood and Webull. But again, stock market. I just want to point out something because a lot of people are a little bit confused as to why you should put money in the stock market. I'm going to go with an unconventional route, but everyone here by now, if you don't know and anyone new, top 10% of the wealthiest own 89% of the stock market presently. Now, why do they keep their money in the stock market? I have it on the screen for you. This is just the S&P, but generally over the last 100 years, and in this case, for the last 50 years or so, S&P has been doing 11.8%. The other stock market averages together about 10%. You take off about 2% for inflation, the unreal inflation number, and therefore you are doing somewhere around 8, 9, 10, 11% annually. And then remember that 10%, let's say, that compounds a little bit depending on if you have dividend stocks and a few other things. So once again, this is very important. If you're an ordinary citizen, there are some people that poo-poo your idea when you say I'm investing in the stock market. But long term is where you're going with the stock market. And what is long term? It could be 5 years, it can be 3 years, it can be 2 years, it can be one. So it's long term is relative only to the individual. But literally, if you are 18 years old, 19 years old, 20 years old, and you just simply put in $50, $100, $200, $300, whatever you can afford, every, let's say, paycheck or every 2 weeks, every month, over the next 30, 40 years, it compounds, it keeps going up, and it keeps improving for you. You don't know where you would be, but it could be seven figures. More than likely it would be, because that's what happens. 10%, 10%, 10%, 10%. It starts adding up year over year. It's a slow burn to get there, but you will get there over time. Now, if you want to speed it up, you can, but you're going to have to do a little bit of something different. which is why I have this Stop Struggling Now channel, because we just don't talk about stocks. You're going to have to implement a business, and you're going to have to implement making money while you sleep, which you can do with stocks as well. So stay tuned, ladies and gentlemen. How about double-digit returns annually on your stocks? Not just 10 or 11. How about a little bit more than that annually? Stay tuned. We're going to talk about that. Now, I have this Google calculator here for a reason. And the bottom line to the story is, right here is the global stock market indexes for 2022, but we're not going to talk global. We're going to talk about right here in the United States. Year to date, January 1st until October 9th, 2022, here it is, ladies and gentlemen. The Dow Jones, minus 19.38%, damn near 20%. NASDAQ, negative 31.91%. For everybody on podcast, that's right, you guys get it too. S&P 500, negative 23.64. Those three indexes total over 70%, nearly 75% loss. Where do retired people, the baby boomers, generally keep a lot of money into? You guessed it, the stock market. All right? So now, a person retired a few years ago who had $1 million in their account, and they're sitting there going, okay, I think this probably lasts me for 20 years. Oops, I blew it, right? They'll say like 20 years or whatever, and it looks like I clicked on something, but it's okay. Let's get down here. $1 million, all right? Now, we times this by, well, I'll do 0.25 because that's what it boils down to. 74% is almost 25%. So 250,000 is gone. So right now they're going to have 750. Now, if you're going to live by the time you retire, some people retire at 50s, 60s, 70s, but some people could live an extra 20 years. That's not out of the realm of possibility after retirement. So now you have to start dividing this 20 by 750,000, and then you realize, wait a minute, that's not even 40 G's. That's less than 40 G's. So now I'm only doing 30 G's, $3,000 a month. Some people would say that's fine. Others would say, well, I kind of like a new car and I kind of like some things. So you might be spending 2 or 3,000, or you still haven't completed paying off your house, let's say, or your college tuitions for kids or grandchildren. And you're sitting there going, well, wait a minute, this school's going to cost us $15,000 a year. They're going to be there. That's 60, 70,000 books and all that. You start calculating, all of a sudden, you're like, wait a minute, we might run out of money here if we live 20 years. Because you know one thing you're going to count on, ladies and gentlemen, inflation. And that's going to go up. So let's talk about what else you can do with stocks. You can get an ETF, but you can also get what they call an I bond. And where do you get those? You get them at Treasury Direct, and you can pay for them right here. And you see here 9.62%. And this is literally nearly the safest thing that you can invest in. And they calculate based on a fixed rate plus the inflation rate. So that's how we get up to 9.62% for the I bonds. And the good news is you don't have to hold them that long. You can hold them for 6 months to a year or 30 years. But you're earning 9.62%, at least for the 6 months. Because every 6 months, they change it. All right? They change their rate. May 1st to October 31st. So you know they're going to change their rate. That rate holds for the first 6 months you own the bond. It may change after that. The good news is you can get rid of them. But again, 9.62, and then it compounds on top. So that's a good thing as well. The eighth wonder of the world is in effect. So you can back out anytime you want, but you can hold on to it for 30 years. Like you can go get a grandkid a bond right now that's $20 or $100 or $1,000 and just let it sit there. that was just born. You could say, let me put this $1,000 or whatever, 3,000, 300. It doesn't really matter what it is, and let it ride. And by the time they're 18, 19, whatever, who knows what it'll be, but that'll be, they graduate from high school 17, 18 years later, 10% plus interest if it went that long, if we had a bad economy. Because remember, if inflation rate goes down, then the I bond rate goes down. So that's the reason why you want to make these sometimes short term, like in this case, because you might end up getting 9.62%, and then the next time it might be 10%. But then when they start reducing the interest rates and inflation starts declining, then this starts declining as well. So again, that's one thing to think about. It's short term, by the way. We can do something else. If you miss our live streams on Monday, Wednesday, and Friday, you shouldn't, because this is what we talk about late night. And we have a chat room, and members of the channel can join me on the screen and talk about anything they want. And so those are the kind of things that we discuss at nighttime. So I decided to make videos about it. So please stay tuned. Here's a dividend ETF by J.P. Morgan. Everybody on podcasts, and hear me around the world, it's J-E-P as in Paul, I. They give an annual return of their stock. Their stock price is $51.32 as of now. They give a dividend of $5.78. That is 11%, ladies and gentlemen. How do you like that little stair step there? 11.26% based on this. Their last ex-dividend date was October 3rd. All right? The dividend is paid every month. So you get an idea where you can get 11.26% if you buy at this stock price. If the stock price goes up, then your dividend rate goes down. If the stock price goes down, your dividend yield goes up. So therefore, this is J.P. Morgan, relatively safe, a nice little premium income ETF. Check it out. All right? It's that simple. So you can actually pre-plan what you want to do, but you have to be patient. Now, here's where I come into play, ladies and gentlemen. Let me know what you think down below. Do you see this right here? This is from March of 2020, 2022. But I can't remember if this was redone. But nonetheless, here's where we are. Here's where we are. Current S&P 500 is in dark blue. 1929 to 1930. And again, if you're on the live streams, you've heard me talk about this for over a year. Talking about it's 1929 to 1932, ladies and gentlemen. The reason why I say this is because that's what's happening, and that the same thing the Federal Reserve has done now, they did in the 1920s. The same tariff war stuff that happened, they did that in the 1920s, the isolationism, to cut off the rest of the world so that United States citizens had to pay more money. But yet you're not making more money. So now you have inflation and prices go up. Same thing happened, and now the stock market is almost matching. Look at this. And not to look at it as in just a macro view. Yeah, let's talk that kind of way now. How about the micro view, ladies and gentlemen? When we start looking at, look at this long drop, that 10%, that 12%, that 15%, that 20%. Then all of a sudden they have a few up days. So now you go back up 1%, 2%, 4%, 5%. But then we have some drops back, took off another 1 or 2%. Then we go back up 5%. But then what happens? A further drop. Notice the match. Notice the match, ladies and gentlemen. This is matching. All right? This looks familiar to me. I don't know about you, but these charts go up to make you feel good, make you want to put your money in, and you're sitting there thinking, yeah, it went up for 2-3 days in a row. It must be over. It's not over, ladies and gentlemen. It's not that simple. All right? Now, This is why I keep saying it, because the Federal Reserve is going to have to increase the interest rate at least 2 or 3 more times. There's no way around it. So therefore, there's going to be more pain on the stock market. There's going to be a contraction because people aren't getting debt, so they're not spending money, because most of our money, which our dollar bill is a debt note, most of everything is a debt. So it's based on, I can borrow $1 million. That means I can go spend $1 million of invisible money. That creates inflation. And when the Federal Reserve prints money out of thin air, that creates inflation. And they're going to help their buddies out, so they still are printing money, even though they said last year they were going to stop doing it. So therefore, inflation is going to be here to stay. And then if that's the case, then guess what else is going to be here to stay? 1929 to 1932, and the market's going to continue to go down, then go up a few days, then come back down, then go back up a few days. The same thing's going to happen. And yes, I know, ladies and gentlemen, I'm just a YouTuber, and yes, I do not have a financial advisory certificate of some sort. No. But you can do the exact same thing. Do your own research. You don't have to buy dollar cost average, because if you actually believe that this is 1929 to 1932, then you're buying still at a higher price than the stock should eventually get to. So why are you going to keep buying at a higher price when you can just sit back and say, you know what, I'll wait till it goes down another 5%. Some of you will say, well, Eric, what happens if it starts going up? I want to get back in. I don't want to miss that return. That's fine. That's how it's supposed to work. You may do your own due diligence. You do your own thing. But the fact of the matter is, I believe we're in 1929 to 1932, where we're going to lose more than 25% on average across all of them. I think we've got some more pain is coming. I don't know what the number will be, but I'm willing to sit back and relax. You know why? Because if you buy right now, and let's just give you a perfect example. Let's say you bought at $100 per share. All right? Look here on the screen as I'm discussing this. This is how many days a bear market has happened on S&P 500. All right? And here's 1929 to 1932. 998 days. That's 3 years damn near, right? All right? Just keep that in mind. So if I have a stock that goes from $100 down to 75, and I'm doing this dollar cost average stuff, and I use my bullets, the dollars in your duffel bag of cash, I use my bullets and buy at the $75 level, that money's off the table. But then it goes up a few days, a week, and you're like, it went from 75 to 80, 83, 84, and you're thinking, oh man, it's over. I can put some more money in, and now you may buy at 84 or 85. But then all of a sudden, it drops down to 69, 70, 68, and you're like, damn, I wasted that first bit of money, and now it's even lower than it was now. So again, you can play at dollar cost average if you want to. That's fine. Everybody has their own investing strategy. But at the same time, if you would have waited and it goes down to 60, wouldn't you like to buy at 60 versus the 85 or the 75 or the 70? 60, you can use the bullets that you use, you can buy more with the same amount of money. So all I'm trying to say is sometimes you have to think above the fray. You don't have to go the easy route. And sometimes you can't win them all, but I will tell you this. If the stock was $100 and all of a sudden it did go back from 70, 75 to 80, 85, I'm still buying below $100 when you really start thinking about it, right? So there's no reason to panic after it's already dropped 30%, 25%. What are you panicking for? If you believe in the stock to begin with, it probably is going to go above that if it's a well-known, reputable company. All right? So I just wanted to show that real quick. And then I wanted to show you something else. Because a lot of people think you live in a world all by yourself. You know what this red represents? The maroon, the burgundy? That represents markets all over the world that are negative. If you're negative all over the world, doesn't that mean it's going to affect like a little disease? The rest of the world's going to be under pressure? If you have high inflation around the world and everything costs way more than what people can buy it for, people are getting laid off, they're dying from whatever diseases. Next thing you know, we have problems around the world. You're not getting out of this. You're not going to be able to be unscathed. The United States of America, the reason why they can stay the least scathed of all countries is because they have the world currency. All right? So don't leave yet, ladies and gentlemen. We're about to get into some other stocks that you can get. Remember, we ended at 11% roughly, right? So we have some more coming up. But I just wanted you to know negative 41% is some of these countries. You can see where that is. You know this is like Europe, right? Some of the Eurozone in deep red. All right? The former Soviet Union, deep red. United States, deep burgundy. Just to give you an idea, minus 15.7. You seeing this? Minus 41 is Russia. China, minus 15, the same as us. Because the yuan and what they're doing over there, they're doing extra trading. So they're able to do, and they have the central bank printing money as well. But down here, look at this. Argentina. Right. Look at that. Zambia. Turkey. But Turkey has inflation off the wazoo along with Venezuela. So all I'm trying to say is think about what's happening here. These are stock market indexes, ladies and gentlemen. That's how bad this is. But again, some of these countries have high inflationary rates. These indexes have declined greatly. So I just want to show you that. Because why else would I go through all this just to get you no way out? Okay? Now, the difficulties of trying to time the market, I'm going to have this article down below for you. This is a must read, in my opinion. This gives you all the reasons why the stock market says, hey, don't time the market. Put your money in here. I need you to give us some money. Because remember, some of these top 10 percenters, these that own 89% of the stock market, they're seeing their stocks drop 30%, 40%. They're sitting there going, please, please, somebody buy this up. In fact, we need high demand for this. Let me get rid of this stuff. Who do they need to do that? They need you. So you don't have to be AKA the sucker. You could just go, hey man, this is 1929. I want to see how far it's going to fall. I'm going to sit back with my duffel bag of cash, nice and cozy by my lit fireplace with my wine, sit back and just watch the devastation, because all roads lead to devastation because of everything that's been done for the last 13, 14, 15 years. So I'm going to leave this here because this is the reason why people invest every 2 weeks or every week or every other month and do the dollar cost average. Again, do you, but just keep in mind, sometimes if you find something that you believe in, then you go for it. And I believe that these have further declines coming, just like the housing market. Eric says, all right, Prospect Capital, ladies and gentlemen. Remember we got to 11%? Here's PSEC. Now, remember, these are companies that are going to be in the real estate business. They're going to be in the capital business, loan business, things like that. So just remember, these are high risk. I don't know about high risk, but they do have high rewards. 11% dividend at this price point. If this drops down further, then they might reach 10. In 2020, this was up to 17% return on your money, which I'm still getting to this day. Because I bought when it was 17% dividend rate. That money 2 years ago is still earning 17% because I bought at another $1.50, $1.60 less than this. All right? So just think about that, ladies and gentlemen. Just think about it. All right. P as in Paul, S as in Sam, E as in Eric, C as in Charles, Prospect Capital Corporation, 11% dividends they pay every month as well. Refi. Here it is again. It's a real estate. It's a REIT, really. And notice we're creeping 12.7% at the $14.80 price for refi, REFI. That's a REIT. Yes, interest rates could affect the REIT. But traditionally, REITs during an economy such as the one we have now tend to stay decent and keep giving their dividends out. They're near their 52-week low to boot, which is a good thing. So now not only can you win on the 12.7% dividend, but when the economy turns around and nothing catastrophic happens to the company over the next 6 months and they start reducing interest rates, then the stock price will even creep back up and you'll still be earning 12.7% on the money you spend today. That's how it works, ladies and gentlemen. This is why the big boys get richer, because they're able to put in hundreds of thousands of dollars. And now just think about it, $200,000 and somebody's getting $24,500 every year just sitting there. Yes, you have to pay capital gains, but it's all right. Just don't cash out in a year or two, right? Then you pay less in capital gains. But anyhow, let's go to the next one. AGNC. A as in Apple, G as in George, N as in Nancy, C as in Charles. I know, if you can see this, this says 18.3%, ladies and gentlemen. All-time low, not all-time low, 52-week low, $7.82. They're at $7.87 right now. They're getting beat up. Mortgage Management, LLC, they might be getting beat up. And this is going to be another high risk, but there's high rewards. 18% per year. And again, just like PSEC, they pay out dividends every month. So again, you could see where somebody that said, hey, I'm putting in $100,000, and at the end of the year, they have $18,000 and $18,300. You're sitting there going, man, that's pretty good. That is hella good. People have real estate and doesn't get returns of 18% or 10%. Come on. All right. Now, here goes one last one. All of these, high risk, only put in what you can afford. But again, high risk, because this right here is going to blow your mind away. ORC, 22% return. They are near their 52-week low of $7.95 is the 52-week low, and their stock price is at $8.55. I don't know what happened on Friday, but it went down after hours to $8.36. So again, 20% return as long as these guys stay in business and give dividends. This is going much longer than I had thought, but it's okay. Hopefully you've learned something. Hopefully you're thinking, hey, wait a minute, I might be able to park some money over here, especially if these guys keep giving us some money. Now, again, during bad times, if it gets worse, sometimes these companies stop giving out that free shareholder money. Sometimes they'll retain it. Sometimes they'll reduce what they pay. Instead of 50 cents, they'll say we'll give 45 cents a share or 40 cents a share. So that's what your liability is with regarding these type of high risk, high flying, high return dividend funds, dividend stocks. All right. So hopefully that helps you out, ladies and gentlemen. And please, again, like, subscribe, and click the bell below so you get the latest updates. And I know it's hard out here. And that's why I have to come with the real, because the stock market is a way of life. In fact, we want to get more of the stock market into the OC's hands, ordinary citizens. That's you, that's me. That's why you got to get in the stock market, because the big boys play there, and they're not playing there just for the hell of it. They're earning these dividends. Warren Buffett has been doing this for 40, 50 years and creating billion-dollar company based on receiving dividends, and he receives billions in dividends every year now. So if you start out now, even 3 years, 4 years, 5 years from now, you're getting 20% returns. If they're still giving them that way, you would be happy as hell if you put a little bit of money in there and said, hey, wait a minute, I'm getting $1,000 and I'm getting $200 a year. My money's been sitting there for 200. Wait a minute, 5 years, I got another 1,000 in there. Plus, the stock price probably increased as well. So over time, if it's able to keep up, that money you originally put in at 20% keeps earning 20% as long as the dividend stays the same. And heaven forbid if they raise the dividend, which is happened as well. Now all of a sudden you're making more than 20% or 17% or 12%. So just think about it, ladies and gentlemen. Let me know what you think down below. And thank you for watching. Thank you, everybody, for being here once again. And with all that said, keep your head up, keep moving, and I'm out.